Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 170. And once again, Stuart Owen is with us, stepping in place of Richard. Thank you, Stuart. But before we get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. Okay, before we get going, a bit of housekeeping. So this week is the first week where we're going to aim to get it under an hour and a half. Let's see if we manage. For the next couple of weeks, we'll be recording on a Tuesday as I have a couple of hiking trips planned. But after that, we'll be back to the Friday schedule. Now, this week we have an important episode, I think. So please spread the word about the podcast. I hope you find this all useful. Right, first of all, the news. US non-farm payrolls last Friday came in soft at 142,000, and once again the June and July numbers were revised down. It very much looks like the US jobs market is slowing. We've got extended coverage of that. In the UK, out this morning, we had employment numbers. Pay growth came in at 5.1%, in line with expectations, and slowing, but slowing slowly, still too high. Elsewhere, you'll notice that the Labour government, the first thing they're trying to do to cut the deficit is they've reduced winter fuel payments. They haven't cut them entirely, they've made them means tested, but the media, unions, Labour MPs have all been complaining about the planned cuts. And to me, that shows just how hard it's going to be to get the fiscal deficit under control and how the pressure is to raise taxes rather than cut spending. Elsewhere, the oil market had a really bad week, and OPEC Plus have delayed their plans to increase production by 180,000 barrels a day by 2 months. The oil price still fell. Goldman Sachs has cut its copper price forecast on the back of weak Chinese demand. France has a new prime minister, Michel Barnier. Let's see how long he lasts, given that the socialists have a majority and he's a right-wing MP. And equities have had a bad week, and it looks like a double top has formed. SimonW, in his technical analysis, thinks the markets are down from here. We'll take you through it. Some charts relating to the news. Well, this is the S&P 500. It appears to have formed a double top and was down 4% last week. The Mag 7 in particular appear to have peaked for now. But as we discussed last week, the seasonal pattern is for September to be a weak month. Is it simply seasonality? The yield curve has uninverted after a record inversion. Now, historically, that has tended to precede a recession, but as we've covered many times over the last couple of years, this has been an extraordinary business cycle. Will that hold true this time? Now, in the US, tonight there's the big debate between Trump and Harris, and Polymarket have Trump ahead, and ahead by quite a long way. However, Predict It have Kamala Harris ahead. Let's see what happens tonight. It can all change very quickly. The outcome of the election in the US really matters for US corporate tax rates. Kamala Harris is proposing to increase corporate taxes to 28%, which would still be low by historic standards. Donald Trump will keep them at least where they are, but would like to cut them further, which would be catastrophic, I would have thought, for the US fiscal deficit. The carry trade is not coming back, and that has been a prop for global equity markets over the last few years as speculators have borrowed in yen and then bought assets all around the world. If that's no longer happening, then a key prop for global asset markets has been removed. Finally, these are the probabilities of rate cuts in the US. You'll see that now the market is pricing in the 100% certainty of a rate cut on the 18th, but 73% chance of one rate cut, 27% chance of a 50 basis point cut. Over the next 2 years, the market is already pricing in 2.5% of cuts. That's a lot. And on to this week's economic data. Quick summary: the UK economy remains resilient, but the labour market is slowing. The EU economy is weak. Manufacturing in particular seems to be in structural decline, and it's showing little sign of improvement. In the US, the economy remains strong, but the labour market is showing definite signs of weakness. The Chinese economy appears weak, and we've got some interesting data this week. On to the UK, Stuart.
Right, so UK earnings growth, which I believe came out this morning, came in at just 4%, a little below expectations of 4.1%, though the June number was revised up a bit. So that's not too bad. I mean, it was between 6 and 8% over the past year or so, and I know you regard this as vital for inflation coming down.
Yeah, the trouble is, Stuart, that the including bonus numbers are flattered by the fact that there were public sector bonuses, one-off payments in June and July last year that have fallen out of the comparison window.
Hence the X bonuses at 5.1%, much less encouraging. Yeah. Yeah, I mean, if you take off a little bit for productivity, that's
yeah,
it does imply inflation remaining very sticky.
That's right. And we know the productivity growth in the UK is absolutely abysmal.
Yes. Right. So yes, your chart here is illustrating this bonus point from the NHS and the civil service more generally. That falling out of the equation is making all the difference to the numbers. Real earnings growth, therefore, was positive. Hold on. So what have we got? A few percent positive, isn't it? Regular pay, what's that, about 3% real? But if that isn't matched by productivity, that's long term not really sustainable.
Yeah. Although, you can say we're catching up on lost real earnings, but that is not sustainable.
Yeah. So earnings growth does appear to be moderating across both the private and the public sector and across different industries. Yes, there's quite a bit of convergence there, isn't there? Towards and around 5%. UK employment change on the surface looked very positive, up 265,000 in July against expectations of 115.
Well, I'm just going to read this out. This is from the ONS. The number of people employed in the UK surged by 265,000 in the 3 months. So this is over a 3-month period to July 2024, accelerating from 97,000 increase in the previous period and topping market forecasts. It was the third consecutive 3-month period of growth in job creation. It was the sharpest since November 2022. The number of full-time self-employed workers decreased during the latest quarter. On an annual basis, the number of employed people rose by 150,000. So this data is for rolling 3 months. It shows the number of people in employment rising. And the good news is that's driven by an increase in full-time workers.
So therefore, the overall UK unemployment rate was at 4.1%, not too bad, and nudging down from 4.2% in June. The claimant count month on month, not up too much, up about 24,000, and the July number was revised downwards from 135 to 102,000, so that's gently encouraging as well.
But notice, Stuart, that the claimant count has been rising, and the previous chart showed very strong employment growth in the 3 months to July, whereas this is also showing a big rise in the claimant count over exactly the same period. So what's going on? You've had a big increase both in employment and in unemployment.
Yes, just on the surface doesn't make sense unless there's been a big influx of people who qualify, which I
Yeah,
don't think is really the case, is it?
no, that's right. So once again, UK statistics seem to be of quite poor quality.
Oh yes, the HMRC payrolls numbers. Now these theoretically should be interesting and useful. However, we're somewhat skeptical because they get revised so much. The August numbers were pretty poor, down about 60,000 payroll changes. However, the numbers for July have been revised pretty substantially. Previously, they'd said up 24,000. Now it's a reduction of 6,000 in payroll. So I think we've spoken about these before. They might be useful looking backwards when they've been fully revised, but as a timely indicator, they're very flaky.
That's true, but step back and just so ignore the August number. Look at July and June. If we go back a couple of charts to the employment change, you're talking about June and July, strong growth in jobs, according to the employment change survey. But then when you get to the payrolls, HMRC payrolls, it is saying the opposite. It's saying the number of people on the HMRC payroll system actually fell in both months. And previously, the discussion from the ONS was that the growth in the employment count was full-time jobs, great news. But then, where's that? Why is that not showing up on HMRC data? And if you step back and look at this, that is not strong.
No, this year you'd say sort of flat to weak, wouldn't you?
You would.
The broader trend is the UK labour market does appear to be slowing. So what are we looking at here? This is
Actually, can I come in here, Stuart? So this is from the ONS, and this compares the growth. There are different surveys of the UK labour market and looks at the annual growth rate. So you can see that the different bars are, they do vary quite a lot. They differ in detail, but what the ONS is saying is if you step back and look at the annual growth rate, they're all telling a similar picture. And they're saying that UK labour market growth is slowing. So the ONS basically are slightly letting themselves off the hook here and saying that although there's noise in the data, the data is consistent, and it's consistent in showing a slowing jobs market.
Construction PMI, yes, we've spoken about this before, haven't we? This is been surprisingly strong. I'm surprised to find that we're constructing very much, but it's remained above 50 for quite a while, coming in at 53.6 in August. A bit worse than expectations, but I'm more pleased that it's maintaining an above 50 reading.
Yeah, the UK is doing incredibly well compared to Europe. The European construction PMI is awful. It's about 41. And so, last week we were talking about how UK manufacturing was really outperforming both the US and Europe. Well, UK construction is certainly outperforming Europe as well.
New car registrations rather weak, down year on year by 1.3%, as against expectations of a bit of a bounce to plus 2%. Halifax House Price Monitor, month on month, again positive, up by 0.3 in August after 0.9 in July. That followed a bit of a a flat period over the spring and early summer. So turning to the economic surprise indicator for the UK, remaining above 0, coming in at about 16. So yeah, gently positive and encouraging news.
Yeah, I tried to find a GDP nowcast for the UK to replace this chart going forward. But bottom line is I couldn't find a free one.
Right.
So we're going to stick with this for now.
Another take on things from the Indeed job postings, that's not looking very encouraging. It took a step down and hasn't bounced from that.
Yeah. Now, when we talked about employment earlier, this portrays a UK jobs market that has definitely slowed and continuing to slow.
Some slightly different data here about UK equities continuing to see net outflows. I'm always confused by these, though. I mean, someone was selling, someone was buying, so there must have been some reallocation somewhere. I mean, I think we all know that pension funds have been disinvesting from UK equities for the past 20 years under,
Mm.
risk rules. But yeah, who's buying?
Yeah. Okay, so this is a really interesting chart that somebody on the Discord sent me. Thank you. And the point is that the UK fiscal deficit and fiscal spending has risen very sharply over the last 20 years because we have increased the size of the state and people respond to incentives. So one of the things the government has done is increase the scope of child disability allowance. And our child disability allowance pays up to £9,500 a year for children up to the age of 16. And around half of the children who claim disability allowance claim it for social or behavioral impairment. So, in a sense, we are rewarding as a society bad behavior. If children behave badly, they now get child disability allowance of up to £9,500 a year. And as a result, when you look at the number of children claiming disability allowance, you can see in 10 years it has gone from, what's that, 4.5% to 9%. And at the moment they reach 16 and are no longer able to claim disability allowance, the rate at which people claim disability allowance collapses. So it very much seems that a lot of those claims are not valid. What do you think, Stuart?
This is shocking, isn't it? But when you read news stories about individual families with kids who've got a disability, of course, you feel human sympathy for the people in that position. But when you start looking at it in aggregate, and you start looking at these changes over time as the rules are changed, it's very difficult not to become cynical. I can feel myself becoming a sort of angry from Tunbridge Wells Daily Telegraph reader when you see charts like this, that in aggregate, this is an inducement to people to understand and play the system.
Absolutely. The thing is, once entitlements have been granted, they're very difficult to roll back. I mean, I made the mistake of listening to Radio 4 this week. So when they were talking about the government's plans to cut winter fuel allowance for pensioners, Radio 4 was essentially accusing the government of murder, saying that that would result in deaths of pensioners. But they're not cutting it. They are putting in means testing. So I fail to see how that is going to lead to any increase in pensioners' deaths. But you can see the media always on the side of increasing government spending and being very alarmist about any attempts to cut it.
It's exasperating, isn't it? Because you end up genuinely with a welfare state where everyone is supported in every circumstance. And the cost of that, the sort of sclerosis, the
Yeah.
constantly increasing tax take, and the impact that has on the hidden cost is the lack of what happens. Businesses that don't set up, businesses that leave, that is much more opaque. It's difficult to see. The cost is nebulous, but it must exist there. And this sort of chart is so depressing for our future. I mean, if the Tories couldn't do something about this, Labour is going to find it very difficult.
Absolutely. And, when you talk about the costs are much higher taxes, and which is an impediment on, the dynamism of society. And taxes look to me like they're only going to rise. When we talk about the disincentives in society, I mean, in the middle classes, and you'll know this, Stuart, if you declare your child to have dyslexia or a learning disability, you get an extra half an hour or an hour in exams. And so the rise in the middle class, dyslexia rate. I mean, friends of mine at school, they're saying, everyone suddenly has dyslexia because, people respond to incentives. You get an extra half an hour in exams.
Yeah, it's exasperating, isn't it? But by the way, just before we leave this chart, let's not ignore, the picture amongst 50, 55, 60-year-olds. There's a huge rate of the population claiming disability. Presumably, this is partly people not claiming unemployment benefit and getting on the sick, as it were.
Absolutely, you get the benefits are higher if you claim disability, and COVID, long-term COVID, don't feel able to get out of bed. Anyway,
Yeah.
I'll cut that bit. Actually, I won't. They're turning into like a right comedy duo.
So UK summary, earnings numbers came out today, and excluding bonuses, they fell in line with expectations, but they're still at 5.1% year on year. Including bonuses, earnings growth slowed to just 4%. So wage growth does appear to be slowing, but slowing slowly. The UK labour market statistics are all over the place. It's difficult to know whether employment and unemployment are rising or falling. If we had to hazard a guess, the broad image is of a slowing labour market. So bottom line, UK economy has proved more resilient than certainly I expected. There's little sign of an imminent recession. The Labour government is already finding it's going to be a difficult road to embark on fiscal consolidation.
Thanks, Stuart. On to the EU. Very little data this week. The EU sales in July were up 0.1% in line with expectations. But step back and look at that chart. Retail sales year on year fell by minus 0.1%. The consumer in the Eurozone is not doing well. The construction PMI, much worse than the UK, unchanged at 41.4, and that is a bad number and the lowest number this cycle. The surprise index continues to be very poor. Now, I found this data, and we will be reporting this going forwards every week. This is a nowcast of the Eurozone, and it is saying that the Eurozone economy is contracting in Q3. So has the Eurozone slipped back into recession? I should say, though, that the nowcast for Q2 forecast that Eurozone economy was shrinking and actually came in at plus 0.3 quarter on quarter. So there may be a downward bias to the nowcast. Turning to the job postings data, German job postings continue to fall gently. French, having collapsed pre-election, are recovering a bit. This is not good, and this is a fundamental problem for the Eurozone, is that they are suffering from industrial decline. Now, Part of this is EVs, where Europe has traditionally been very strong in the manufacture of internal combustion engine cars, but China is dominating the market for electric vehicles. And last week we were talking about how Volkswagen were planning to cut jobs. Well, high energy costs and competition from China are undermining industrial production in Italy and Germany.
Keith, before we leave that chart, I think it's which obviously shows Italy's industrial production compared to Germany's. I think it's very telling that the gap started to grow just as the euro was introduced, and Italy became unable to devalue its way back into growth. But I think more broadly, seeing both of those lines going down, that really does summarize Europe's problem, doesn't it? And I believe, was it yesterday, Mario Draghi came out with a big report about how Europe can stop being a sort of pancake of just flat growth, flat consumption. But the things he wants, or he identifies as being necessary to reinvigorate growth, it looks politically so difficult given the amount of populism across different European countries. The idea of a further integration, I think, is going to be heavily resisted. It might be the right diagnosis, but the prognosis does not look good for political reasons.
Yeah, but as we've discussed many times, the fundamental problem for the Eurozone is it's not an optimal currency area. And his proposal basically are to turn it into an optimal currency area through more integration, fiscal transfers, the issue of common Eurozone bonds. None of that's going to go. So,
Yeah, but also regulatory alignment across every country so that capital markets can integrate and deepen.
Yeah.
Yeah, it's the right diagnosis, I think.
Now, this is really interesting. Look at the yellow line. That is Poland. Look at the blue line. That's Spain. Poland, in one generation, is going to go from having a GDP per capita, half of that of Spain, to overtaking it. Absolutely extraordinary.
That is remarkable, because I thought Poland was suffering from political infighting and instability and insularity. But look at that. That's amazing.
Yeah, absolutely amazing. So the joys of capitalism. Drop communism, unleash market forces. Off you go. EU summary. Well, July retail sales were anemic. The EU construction sector remains in deep recession. The bottom line is the EU manufacturing sector appears to be suffering structural weakness as exports. So over the past few decades, it has been a big beneficiary of exports to China, exporting machinery to China. And now the Chinese economy is slowing. So the EU manufacturing sector is slowing, and it's suffering from competition from goods from China that its machinery helps to produce. So the EU economy is being supported by the services sector, but is not growing strongly. On to the US, Stuart.
Right, US non-farm payrolls. I believe we're going to go into this in a lot more detail because it's very heavily affected by cyclical factors. For what it's worth, the August number came in at 142,000, a bit worse than expectations of 160,000. More tellingly, the July number was reduced from a first estimate of 114,000 to 89,000. Government payrolls have taken a step change down since last year and the beginning of this year, but was still up 24,000 in August. Private sector payrolls up 118,000. July's number was revised down from 97 to 74,000. Labour force participation rates almost, not quite reached the pre-COVID levels, but certainly has bounced back a lot. But once again, all the jobs created were part-time jobs. Full-time employment actually fell. So since June 23, full-time employment has fallen by 1.5 million, and part-time has more than made up the gap by a rise of 2 million. This is all according to the household survey. But clearly quite a fundamental change in the structure of of the labour experience in the States. And the numbers were big. So full-time monthly change in employment level was down 400,000. Part-time was up 527,000.
Yeah, big numbers.
Yeah. So that's obviously a big problem for the Biden administration. But it's also a problem because it seems to be those who were not born in the States who are taking the jobs compared to those who were born in the States. So the blue line is job creation for foreign-born workers, which is showing a very strong rise.
I take this to be new immigrants taking the jobs, i.e. young people, and actually the failure of native-born workers to find jobs. I think that is more a reflection of early retirement, so people leaving the workforce voluntarily.
Right, so it's an age thing, yeah.
Yeah.
So in order to avoid a recession, the downward trend in non-farm payrolls needs to reverse. Now that has happened before in the mid-80s and mid-90s.
Yeah.
Yeah.
So basically the Fed needs to cut rates to stimulate the economy and reverse this trend, because once it gets going, the trend tends to continue until you get a recession.
So non-farm payrolls keep being revised down. Since April, the first downward revision has been followed by a second one each time. Now, I think we've spoken about this before, haven't we? That this is largely to do with the births and deaths model that they have to use. So you observe how many jobs were created in existing businesses, but you don't know how many businesses have gone out of business, how many have been created.
Yeah.
So you make an estimate of that, and your estimate tends to be the average of recent experience, which is probably the best you can do. But obviously, at turning points both ways, you're going to be getting it wrong. And at the moment, you're going to be extrapolating growing businesses, a growing number of businesses, which in reality aren't there. And therefore, you're going to be overestimating jobs. Conversely, in a couple of years' time, we could be seeing the opposite effect. But for the moment, that downward and continued downward revision of jobs numbers sort of indicates that the cycle has peaked and that job creation and business creation is weaker than it appears.
Yeah. But the numbers are really quite shocking. And June revised down a second time. The headline number was 206,000. After two revisions, is 118,000. These are big revisions.
Yeah. So over the past 12 months, revisions to non-farm payrolls have averaged about 30,000, negative 30,000. So this is what we're talking about, that there's cyclical information in the direction of revisions and the fact that the revisions themselves tend to trend. So despite the negative revisions to the non-farm payrolls, there's still a big divergence between the establishment and the household surveys, which were pretty aligned in 2020 to 2022. But now there's a pretty big gap, isn't there? The composition of jobs growth is not particularly encouraging. The biggest increase has come from the healthcare sector. I'm assuming this is not doctors. This is, old age people's homes and care workers. Government, which obviously is a very broadly defined category, is the second biggest source of growth. Leisure and hospitality. Is that just baristas? It's not particularly a compelling picture, is it?
Well, it's strange that construction has seen such strong jobs growth over the past year when you know that high interest rates normally cause the construction industry to be the very rate sensitive and to be the first sector to lose jobs. Now we know, as we covered last week, that job openings in the construction sector have collapsed in the last 3 months. So are we now going to see the construction sector finally start to lose jobs? It hasn't happened yet.
JOLT job openings, this is a bit of a scary chart, isn't it? The job openings have been declining since, well, for 2 years now, and that's a pretty remorseless number. Average hourly earnings month on month, though, still pretty decent, up 0.4% in August. So converting that into a year-on-year rate, earnings growth was 3.8% in the States. I mean, that just strikes me as the perfect level, doesn't it? If 1.5% of that is productivity plus a bit of inflation, that's pretty much where you want it to be, isn't it?
I agree. Well, productivity growth in the US has been actually really strong. So when you look at the labor cost index, it's very sustainable.
Yeah. The unemployment rate, 4.2%. Obviously, there's issues of definition here, which we spoke about last week in the context of the SARM rule, because obviously the unemployment rate is a ratio, number of people looking for a job as a percentage of the labor force. So that can be affected by the growth of the labor force. A different definition of unemployment is the U6 definition. And the U6 rate includes total unemployed, plus all persons marginally attached to the labour force, plus total employed part-time for economic reasons as a percent of the civilian labour force, plus all persons marginally attached to the labour force. So different definitions will give you a different picture of why unemployment and where unemployment is.
So this
7.9%.
Yeah. So this is interesting because the unemployment rate headline down. Actually, if you look at U6, it's up.
And it has been trending up a bit, hasn't it, since the beginning of 23?
And I think the big difference actually is part-time for economic reasons. So people out of work are accepting part-time jobs for income, but they would like a full-time job. And so this shows much more labor market weakness than does the headline number.
Yeah. Job losses are rising, and this is concerning as a prediction of recession. So we have the job loss rate here, the 6-month average, which has clearly bottomed and is picking up.
Still low, but picking up. What's really interesting is the job finding rate, which is at really very low levels. If you're out of work, it's difficult to find a job. I mean, that is below the depths of the 2000 and the GFC recessions.
Yes, that is surprising, isn't it? Because we've got used to there being a bit of a labour shortage in the States.
Yeah.
Longer. The rise in the long-term unemployment rate has been very unusual outside of a recession. Well, this cycle has bemused us in many respects, hasn't it? Not just the yield curve, but also the unemployment rate, the long-term unemployment rate. However, I think we're about to go on to an important point of understanding about long-term unemployment.
Yeah, section coming up.
Right. The rise in unemployment is being driven by falls in temporary employment. Right. Okay, that slightly surprises me given what we just talked about in terms of, I suppose there's a difference between part-time and temporary employment, isn't there?
Yes, that's right.
Okay. So, right, people have got temp jobs. So again, there's a slight element of, getting income wherever you can and taking whatever is available.
Yeah, but the jobs that companies are shedding are temporary jobs. But again, signs of a weakening labor market.
The IT sector has seen the most job losses, and that looks like it's going to be a very continuing trend. That is an extraordinarily straight line, isn't it? The red line here.
Yeah, now I really wonder, Stuart, whether this isn't the delayed effect of interest rate rises. And in particular, when interest rates were zero, you saw loads of startups.
Yeah. So this isn't just, Meta and Google laying off people.
Yeah.
This is right, the startup shakeout.
Yes. As we know, to our cost from our angel investments, a lot of them finally running out of money and going bust.
Well, as long as they would go bust and crystallize the loss, but that's a separate issue.
Yeah.
The sum rule we covered in more detail last week, but just to say it's risen further above its triggering level, and it's now at 0.57%.
So this chart shows in blue the SARM rule, which has triggered, and in red, just if you look at prime age employees and the rise in prime working age, that's 25 to 54-year-olds, there's not showing a recession at all.
So is this backing up your point about the sort of demographic profile of unemployment, where it's concentrated in older workers,
Yes.
native-born workers? It's the further evidence of that.
That, and I think, the low hiring rate means that new entrants to the workforce are failing to find a job.
The JOLT job quits rate, this is always, I think, useful. How confident are people in quitting their job to get something else? And that's been trending down for a couple of years now, not encouraging.
Yeah, you notice the June number was revised down, and that makes July look better than it is, frankly.
Yes.
That is well below pre-pandemic levels.
The jobs to unemployed workers ratio has returned to pre-COVID norms. So that's not, so this is, there are fewer jobs per unemployed worker. Right, got it. Yeah. The hiring rate has steadily declined, and that's rare outside of a recession. So across the board, many indicators of not a collapse, but a distinct slowing, isn't there?
Yeah, absolutely.
The layoff rate is low, but there are some signs of a pickup in that too.
Yeah, not much for pickup. That is a very low level. So the hiring rate's really terrible, and the layoff rate is really low. It's like the great stagnation, labor hoarding.
So one ratio that we can look at here is hires divided by the unemployment rate, i.e. the rate at which the economy can clear the number of unemployed people. So that has been falling pretty precipitously, hasn't it?
Yeah.
Construction jobs are finally falling, and falling hard. Yeah, well, I think we covered this before, didn't we? No, I could totally believe that construction jobs, which are to do with data centers, wind farms, building semiconductor plants, etc., had been strong over the past few years. But traditional construction, in the sense of commercial buildings, residential housing, roads, etc., that presumably has been weak for ages.
Well, I wonder how much of this is the CHIPS and IRA acts incentivizing. We know that there's been a big surge in manufacturing investment leading and chip plants, etc., in the US, but those were all, paid for, incentivized back in 2021,
Right.
22, and
Yeah.
at some stage those projects get completed.
Well, these are job openings, aren't they?
Yeah.
So, you only get the benefit as those projects are begun. Even if they're continuing, they're not going to add to the workforce. So do construction jobs lead the wider employment market? Well, they do seem to, don't they? Because the lead here in the chart on the dark blue line does appear to predict the light blue line of the overall employment construction numbers.
Yeah.
Again, no catastrophe, but definite weakening.
Yeah. The thing is, I would also caveat this by every correlation in this cycle has just not worked. So, historic correlations, I mean, there is one, but, will it hold this time? Not so sure.
Continuing strength of construction payrolls has been surprising, but I think we are seeing that reverse, aren't we? We're seeing many signs of that across the other statistics. Challenger job cuts. Oh, this was a bit of a bump up, wasn't it? I mean, nothing like obviously during the pandemic, but up to 76,000 after being in the low 20s before. Challenger job cuts versus pre-COVID monthly average. So the job cuts were 81% above the pre-COVID average. I was also struck in this chart, but by the regional allocation, very much happening in the West.
Yeah.
So that's I mean, that's my image of where the tech industry is. I'm not sure how accurate my image is, but that may be confirming evidence that it's that industry that's having the shakeout.
Yeah.
A different measure of employment change from ADP, up 99,000 in August, but expectations had been for 145,000, and the July number was also revised down a bit.
Yeah, so confirming slowing jobs growth.
Labour productivity quarter on quarter, pretty good number this. I think the UK would kill for this number by 2.5%.
Absolutely.
Fantastic.
Yeah, and that means you can afford wage growth.
Yep. Labour costs quarter on quarter, therefore, were up only by 0.4%. Q1 had been 3.8%, but the previous quarter had been negative. So, over the past year, this looks a pretty attractive number. The ISM services PMI, just about okay, 51.5, but has clearly been weakening over the past couple of years.
And by historic standards, that's a very weak number.
Yep.
It's normally averages about 55.
Yeah, so expanding, but not as strongly as usual. New car sales in the US, well, that seems to me to have sort of plateaued for the past year or so, about 15.1 million annualized rate in August. But just looking at the chart, that just looks to be the new normal.
Yeah, I thought this was really interesting. Just stepping back and look at pre-pandemic to now, that's actually quite a big drop. You're selling about 10% fewer cars than you were pre-pandemic.
Johnson Redbook retail sales 6.3% up this week. Last week was 5%. So that's a pretty encouraging chart.
Yes, but the devil is in the detail.
Right. Yes, the composition. So department store sales were minus 0.6% year on year. Discount sales up 8%. So clear evidence that people are struggling and are going to is that discount as in sales that were made at a discount to the normal price?
No, it means
discount
it means discount stores.
Right.
So Dollar General and places like that.
Yeah. And they themselves have been, I think, reporting bad earnings numbers. They may be selling more, but at lower margins than expected.
Yeah. So actually, I'm now going to stop reporting the Johnson Redbook retail sales because it is clear that the distribution of sales between discount stores and department stores is actually what matters. So what we really care about is department store sales. And that is, I thought that's what the Johnson Redbook retail sales number represented, but it doesn't. It's a composite.
US initial jobless claims, well, there isn't great evidence of a pickup in problems here. Came in at 227,000, slightly lower than the recent average. Initial claims versus recent non-COVID average so a little bit higher than the recent average.
Yeah, because there's very strong seasonality in claims.
Okay.
So it is running higher than the pre-COVID average.
Continuing jobless claims. Now on the surface, this looks like good news, doesn't it?
Yeah, but
continuing jobless claims have been coming down, but there is a but.
There's a but, and we have a big section on this coming up. Bottom line, it understates the rise in unemployment, and we'll go through that in detail.
So continuing claims versus their recent average is also pretty elevated, 15% above the non-COVID average.
But not accelerating.
Continuing claims shows very strong seasonality. So it is falling, but it is elevated relative to the pre-COVID average. So turning to some of the nowcast economic forecasts, the US Dallas Fed's latest estimate is for growth of 2.4% in GDP, not bad. Atlanta Fed 2.1%, though that's down on their forecast previously of 2.5%. New York Fed 2.6%. St. Louis Fed 2.1%. So it's all perfectly decent numbers, not perhaps quite as great as Kamala Harris would like, but 2.5%, not bad. Thank you.
Yeah, decent.
The US version of the Economic Surprise Index, not very positive though. -30. And obviously the issue here is what were expectations?
Yeah.
Negatively surprised. Growth itself is fine. The unemployment picture is beginning to look concerning, but perhaps people have been hoping for even better numbers. Indeed, jobs postings, well, it looks a bit flat to me. It's come up a little bit recently, but more broadly, just going nowhere, which I think that is sort of the picture that we have from the official statistics, isn't it? US trueflation, about 1.2%. It's always important in the States what's happening with gasoline prices, and they've been falling pretty sharply. In fact, more than you would have thought, just given the weakness in the oil price. So not good fundamentally for demand in the US. Good for inflation, though. I would say also good for Kamala Harris.
Yeah, absolutely. But it portrays an economy where gasoline demand, which is, fundamental to a lot of economic life, is weak.
Yeah.
So further evidence of the US economy not growing as strongly as it has been.
So the US, in summary, the jobs market continues to slow. So this implies weaker wage growth and slowing inflation coming down the pipe. The nowcasts still estimate the US economy is growing pretty decently, around 2.5%. But those gasoline futures, they do imply a weakening picture of domestic gasoline demand. So the US remains strong, no imminent sign of recession, but the jobs market does appear to be showing many signs of slowing.
Yeah. Okay, on to China. Thank you, Stuart. So a few data points out this week. Exports strong. Numbers out this morning. 8.7% year on year, well above expectations. Imports, though, weak, only up 0.5% year on year. Balance of trade, therefore, surprised the upside. 91 billion in August. The China is attempting to export its way out of trouble. Caixin Manufacturing Index was better than expected at 50.4, well up on July and back in expansion. Services, weak, 51.6, down on July, well below expectations. Therefore, the composite was unchanged at 51.2. Chinese economy appears to be growing, but below the target of 5%, I would say. Very difficult to know, of course, from the manipulation of Chinese statistics. The inflation number for August came in at 0.4%, below expectations year on year, 0.6%. So very weak inflation in China, but no longer deflation. Producer price inflation was minus 1.8%. So very little evidence of pricing pressures in China. Now, this I thought was really interesting. And you look at one chart for China this week. This is it. This is fuel consumption. So oil consumption, petrol consumption. Bear in mind, the Chinese economy is meant to have grown. It's down on 2020, i.e. 4 years ago, substantially below where it was. Now, part of that will be electric vehicles, but the Chinese economy is meant to be growing quickly. Diesel consumption, same pattern, well below where it was 4 years ago. Only airline fuel consumption is up, and even that has started to slow. Overall, when you look at total oil demand, oil and oil product demand, which is the chart bottom right, you'll see that it has grown compared to 2020, but this year is down on 2023. Now, bear in mind that China is the manufacturing center for the entire globe, and a lot of that fuel demand will be for plastics and for oil products that are not gasoline. So that suggests to me the Chinese economy ain't doing well. And that has big negative implications for the oil price because China has been a key driver of oil demand over the last 2 decades. So this is Chinese flights, and you see dropping quite sharply. Now, China is at the end of an extended property boom. That has left it with very high private sector debt levels. So you see the black dots are current levels. China is at 200%. Now, only Japan, at the peak of its property bubble, was private sector debt to GDP higher. Now, what happened in Japan as the property bubble unwound was the economy fell into a prolonged balance sheet recession, i.e., the private sector concentrated on paying down debts, reducing its leverage, which meant that demand was fundamentally weak while the entire economy deleveraged. So the private sector deleveraged. I expect a similar thing to happen in China. So that means the Chinese economy will be structurally weak going forwards. Now, because of the manipulation of Chinese statistics, The Economist in 2010 created the Li Ka-shing Index, which just looked at three statistics which were difficult to manipulate. They were railway freight traffic, electricity consumption, and total bank loans. And that is the blue line. And you can see it shows the Chinese economy doing okay, but not great. When you look at the Chinese population, this is the absolute change in population in China. It has started shrinking and it will continue to shrink going forwards. The pink lines, pink columns are births. The yellow lines are deaths. Deaths are rising, births are falling. So demographically, Chinese growth has peaked. We talk about equities. Equities in the West have had an extraordinary run, but equities are dangerous. And if the economy stalls, so equities can stall. This is the Chinese equity market. This is total returns, including dividends. You'll see current level, it is unchanged in a decade. And in US dollar terms, no better. So Chinese summary. August exports were strong, imports were weak. The PMIs continue to be anemic, frankly. Inflation soft. Oil consumption implies the Chinese economy is not growing, or not growing strongly. So to me, it looks like Chinese economy is suffering from the bursting of a property bubble, as we have been long predicting. And now it's going to suffer from structural weakness going forward, and that has negative implications for the outlook for commodity prices. China has been a key driver of demand for commodities going in historically in the last 20 years. Now, everyone is assuming that demand for copper, etc., will force copper prices up going forwards. But the assumption is that copper demand will rise from current levels. What happens if the Chinese construction market continues to slow and instead of rising, copper demand actually starts to fall? Okay, onto one chart. Now, this is the Beveridge curve, which has on the y-axis the vacancy rate, i.e. job openings, and on the x-axis, the unemployment rate. Now, so far in this cycle, we have been on the steep section of the curve. So falling job openings have not really translated into rising unemployment in the US. Well, no longer the case. We are now getting onto the flattening section of the curve, where falling job openings result in rising unemployment. So, if the job openings continue to fall, we should see rising unemployment in the US. Watch this space.
Right. So turning to Simon W.'s technical analysis and his update on the state of the markets at the moment. So I think the important point here is that he calculates the Nasdaq is now topping out and will head lower for a possible consolidation in about a month or so. So I don't know quite how to describe all the lines, but clearly a downtrend is predicted.
Yeah. So there was an up channel, which, is no longer intact. And now you're getting a downwards trend. It seems that the Nasdaq has a ceiling at this downward sloping purple line, I believe.
The S&P 500, not quite the same pattern in the sense that the tops are more level compared to the falling tops of the Nasdaq. So he says the S&P 500 is turning over and is likely heading down towards a mean upward trend at the 23% compound annual growth rate line. There's an overshoot potential to the last major resistance at 526.
Yeah, so the red line here. So it's saying in the short term, the S&P 500 looks weak. I should reiterate that, with on this podcast, we try and, look at the outlook for asset classes on the basis of the economic fundamentals and got it totally wrong over the last year, whereas Simon W., who just looks at the technicals, has got it very right. So hence, giving you his opinion on where markets are heading short term.
So did this analysis really focus on, the next few months? Is that the sort of typical time horizon?
I think actually while trends remain intact, so if the S&P 500 gets into a channel, it's like the analysis remains valid as long as the trend continues. And the reason we're covering Simon's analysis now is that clearly things have changed. So in the last couple of months, the S&P 500 and the Nasdaq having been, rising steadily in a way that you and I find mystifying, but Simon W. had correctly predicted, that stopped. And so he's now saying the technical analysis has also changed.
Right, got it. So turning to the US continuing unemployment claims. So we flagged this earlier that there's an important caveat to the overall decent numbers because the continuing jobless claims seemed to have weakened over the past, is that weeks? Yes, it's a
weeks
statistic, isn't it? However, there's an important caveat because the continuing jobless claims do not accurately reflect a weakening jobless market because the length of the duration of average unemployment means that people are exhausting their unemployment insurance. So the number is down, not because the number of people joining the statistic is falling, but because the number of people leaving the statistic is increasing. They've exhausted their right to the unemployment insurance. So continuing claims are limited by the increased duration of unemployment. So the average duration is shown in the red line here, and that has been increasing. So we have an exhaustion rate calculation here. Is that the blue line?
Yeah.
Which has been picking up. Yeah.
So that's the number of people who have been exhausting their unemployment insurance and leaving the statistic, and that's rising sharply.
So the number of people receiving their final payment of unemployment benefits is picking up. And we see this in the red line here. Obviously, a huge spike during COVID, but I think it's more the trend that we're seeing this year, which is concerning. In most states, the unemployment benefit runs out after 26 weeks. So another oddity of this economic cycle, and there have been many such oddities, is how low the take-up rate for unemployment benefits actually is. Apparently, only 45% of eligible individuals are actually receiving the benefit. I find that extraordinary. So the lower take-up rate reflects the fact that in this cycle, we've seen higher unemployment rates in white-collar workers for whom unemployment benefits only replaces a small portion of their income. So it's not actually that beneficial. So seemingly the stigma outweighs the benefit. For
Yeah.
lower paid gig workers, it's a much better swap.
Yeah. So previously we talked about how IT workers were the main, the IT sector was the main sector losing jobs. Those are high paid workers.
Yeah.
And so for them, it's just simply not worth the bother. Or they go and work for Uber.
Right. Okay.
Hence, part-time work has been rising.
Mm. So all that adds up to the fact that the continuing unemployment claims is rather understating the rise in unemployment and the overall state of the employment market. So, so
So,
if the take-up rates were constant, continuing claims would be about 200,000 higher, and they would be trending upwards.
yeah, that's quite a different shape to the chart.
Yeah. So that has implications for the unemployment rate, which should also, in a sense, be higher than the headline statistics suggests. So trying to adjust for that in the chart here, we've got in the blue line the actual unemployment rate, but then in the red line, a model where the take-up and recipient percentage of unemployment benefits is held constant, in which case you're seeing a rather or less encouraging picture. Is that about almost 5% unemployment rate?
Mm.
The rise in unemployment has been broad across all industries, in particular professional and business services are standing out here.
Mm.
So in summary, the continuing claims data doesn't fully reflect the rise in unemployment because workers who are out of work for more than 6 months no longer claim the unemployment benefit and they drop out of the data. Higher paid workers are not bothering to claim the unemployment benefit. So the bottom line, unemployment is rising a bit faster than you would suspect if you just looked at the continuing claims data.
Thanks, Stuart. Okay, and while we talk about employment, the job openings data also has problems. And thank you to our Discord member, Dodkins, for putting me onto this. So every week we report this, which is the Indeed job postings index. And you see that it has been gently declining. Actually, over the past couple of years, it's fallen very substantially, but it still remains above pre-COVID levels. But the hiring rate is well below pre-COVID levels. In fact, it's at a rate unseen since 2014. So according to the statistics, we've got job openings that remain higher than pre-COVID, a hiring rate much lower. What's going on? Well, if you look at the hires to job postings ratio, it's collapsed. The rate at which job postings are getting filled has halved. What's going on? Well, it appears that a lot of online job postings are fake. They're called ghost job postings, and there are good incentives for companies to post fake job openings. So, particularly when the economy is doing badly, to be seen to be still hiring looks like makes it look like the company is doing well in a slowing economy, and that's good for their image. Also, if you're looking to hire for positions long term, then keeping a job posting open and seeing what CVs you get gives you optionality. If a good CV comes along, you might decide to hire them, even though you're not really formally looking for a job. And finally, fake job openings allow you to do some market research. You can see, how strong the job market is by the number of CVs you get, and also, what salary expectations those candidates have. So for companies, fake job postings, there are various benefits, but for employees, potential employees looking to find a job, they're wholly bad in that you waste time and effort applying for jobs that really don't exist. Now, according to Standout CV, which is a website, around a third of US LinkedIn job postings they flagged as potential ghost jobs, which they defined as posts that had been open for 30 days or more. That seems rather a generous definition to me, but there certainly are a lot of fake job postings out there. Now, ghost jobs should not be recorded in JOLTs because the JOLT survey asks companies to just include vacancies that could be filled in the next 30 days, but it's a survey, so who knows? Bottom line is, online job postings, there's very little cost to them. So for employers, there are various incentives to post fake jobs. For potential employees, wholly bad. But just as we have seen that the continuing claims understate the rise in unemployment, so the job postings may overstate the number of job openings because of ghost jobs.
What a mess, isn't it? Because the other side of this is you hear a lot of applicants who are just using AI to put together their CVs and their covering letters, which produces a sort of undifferentiated mess. And then on the other side, the employers are not truly advertising jobs. It looks like a very dysfunctional way to match things up. It's a mess from both sides. I can see this in my family's job applicants where you've got to apply to so many jobs to find those which are real, and you're hoping to be taken seriously and properly read, but you also suspect that the recruiters are sort of using AI to scan the CVs and applicants' letters. So it's a real waste of time for everybody.
Yeah, I'm completely agree, Stuart. And we're both of a certain age, and my daughter started work last week at a major UK accountancy firm, and in the weeks prior to her starting, she had to do various, frankly, idiotic tests to prove that she could speak English and that she had basic numeracy. Now, given that she's working for a major accountancy firm and she's gone through vast numbers of, selection procedures, that seemed to me to show a fundamental lack of confidence in their own recruitment procedures.
Yeah, I'm sure it's just different silos, isn't it? Different people ticking different boxes, not looking across the. Oh, it's exhausting, isn't it?
Yeah.
Yeah.
So we don't have time this week, but I've done a big in-depth section on the oil market that I'll cover next week.
Right, we're going to have a slight change of tone. We're going to have a bit of a deep dive into the Renewables Infrastructure Trust, a UK quoted stock code TRIG. Now, this is interesting from Keith's point of view because he's looking at possibly changing his portfolio allocation towards yield, and this is a different sort of yield. So we'll be going through this stock. It's actually one that I owned myself. So TRIG, it's an investment trust specializing in green energy projects and infrastructure. So it's mainly wind, onshore and offshore wind, but it also has some solar exposure and a bit of battery storage technology as well. So it's quite diversified in terms of its particular assets. Hornsey, a big wind farm across on the south coast, is its biggest asset at about 10% of the asset base. It's also diversified by country. Do you have a chart on that, Keith?
No.
No. Okay.
It's
It's basically a very good proxy for green energy, wind and solar, and emerging a little bit of batteries as well. So in terms of its vital statistics at the moment, its net asset value is 123p per share, but the share price is 103 pence. So it's trading at a discount of 17%. It's reasonably big, about 2.5 billion market cap. Obviously, the NAV is higher than that. And the management fees are reasonably respectable, just over 1%. It's paid an increasing dividend since it was launched about 10 years ago. It's now up to 7.47 pence per share, which makes a dividend yield of about 7.3%. For the moment, it's covered about 1.6%, 1.6 times. That's after debt costs. If you look at dividend cover before the amortization of project debt, then the dividend is covered by 3 times. Right, so if we look at the long-term performance of Trig, in blue, we can see the share price, which is basically unchanged since the company floated. Though remember, that's just the capital value that's been paying out pretty regular and increasing dividends. The NAV has been on more of an uptrend until very recently. Now, the NAV has fallen because energy prices, i.e. electricity prices, have fallen, and because gilt yields have risen, a higher discount rate has been applied to the forecast cash flows of the company. So if we look at the total return, including dividends, the previous chart was excluding dividends, then the picture looks rather better. In fact, between 2013 and 2022, it was pretty steady uptrend, but it's suffered a quite painful 18 months. And that is mainly because of higher gilt yields leading to higher discount rates. Now, this chart is very interesting. This looks at the premium and discount that the investment trust has traded at. From its launch, for a few years, it traded pretty much around its NAV. But then, in the period of very low interest rates, it began to trade at a pretty chunky premium, almost up to 25% premium to its NAV, because people wanted to buy the yield that it offered. And if this was offering a 5% yield in a world of 0.5% interest rates, people chased it for that headline yield. Since rates started to be raised, however, the opposite effect has come into play, and it's now trading at a discount of about 18%, having touched discounts of about 25%. And I think Keith makes a fantastic point here, is pointing out that it isn't just that the NAV is affected by interest rates, which you would expect, a higher interest rate, a higher discount rate, a lower NAV, but it's the fact that the discount or premium to that NAV is also affected by the prevailing level of interest rates. So you've had a sort of double effect where increased rates have lowered the NAV and have massively impacted people's willingness to pay up beyond that NAV. In fact, they want to pay only a discount. Therefore, if interest rates change and start coming down, you're going to get a double whammy effect where the NAV will rise, but also people's willingness to pay a premium may return. So risks with this stock. Well, there is execution risk. A couple of its wind farms have underperformed just recently, and they have problems with undersea electricity cables. Those problems have been fixed. Now, I've owned this stock for over 10 years. You do get these initial sort of glitches. Quite often they're covered by insurance and warranties from the manufacturers. This, I don't think, is a massive concern. Much more impactful are energy prices. Because half of the company's revenue comes from selling electricity. Now, they will try to lock in power prices with power purchase agreements over 1, 2, and 3 years. So 66% of Trig's revenues are insulated from power prices. That's partly because of these power purchase agreements, but it's mainly to do with the fact that half of the company's revenues come from green subsidies called renewable obligation certificates. And these things are great because they have an RPI escalator built into them. They're part of the subsidies that we all pay in our electricity bills. So in a sense, the risk is almost that there's some retrospective legislation which would undermine those green subsidies, because it's half of the company's revenue and it's guaranteed by contract to go up with RPI. So if there was some retrospective legislation undoing that contract, that would be catastrophic. So to some extent, you've got a political risk. Now, I would say that Labour have been so keen on kicking the oil and gas industry and supporting green that they would be very unlikely to do that. But it is a sort of background concern. The final risk stroke opportunity with TRIG is interest rates. As we keep suggesting, the NAV and the discount to the NAV are very sensitive to interest rates. If those are the risks, what's the reward? Well, dividend yield 7.3%, and I would say it's a yield which is going to grow. There are many of these green stocks, and they've mostly increased their dividend each year. So the company is currently prioritizing paying back expensive floating rate debt, but if interest rates fall, then it should be able to prioritize share buybacks. Again, many of the green companies have been doing that. They want to get the share price back above NAV so that they can issue more shares and grow the portfolio. Over the past couple of years, growth in the portfolio has come to a screeching halt because they can't raise any more equity. But I think that the big opportunity here is if interest rates fall, then you're going to get this double whammy effect. A lower discount rate will raise the NAV. And I think that the point that Keith's also trying to emphasize is that the discount to the NAV could reverse, could even become a premium as people search out for yield again. There are quite a few other green energy stocks. Here's a list of 4 for your consideration and your own research. There's Downing Renewables, Greencoat UK Wind, Bluefield Solar, Foresight Solar. Stop and have a look. Some of them have yields even higher than TRIG's.
Yeah, I'll be aiming to cover those briefly in coming weeks when I get a chance and I'm not hiking. So thank you, Stuart, for going through that. Now, what am I going to do? Well, I have placed a buy order at £1, and I'm hoping that, if equity markets have a bad September, then TRIG will drop with the rest of the market and I'll pick some up cheap. Otherwise, I'll have to pay up for it. But so I think there's an opportunity here, as Stuart's enumerated it, that as interest rates go down, that the share price of TRIG should rise. And I want to buy income for the long term because I fear that capital gains tax is going to rise. And so therefore, these days, you want to buy things and never sell them. And it seems like actually quite a good time to be buying TRIG. So I'm going to be opportunistic in my move into TRIG and put in a bid and hope it gets filled. But thank you to our Discord member, Dan Leeds, for sharing his experience with, and I wasn't aware of this, that these income REITs and investment trusts are not without risks. So this is Digital 9 infrastructure, and it invested in telecoms, digital telecoms infrastructure. And as you can see, it's been an absolutely terrible investment. Mismanagement, open statement of asset values. This is ongoing. And the original management left, and that, frankly, was a signal that all was not well. And if you'd sold at that point, that would have been a great point to get out before all the troubles materialized. But you'll see shares down over 80% in the last 5 years, over that since peak. So be aware that these income trusts are not like bonds. If the underlying, there are dangers in the underlying if the portfolio is mismanaged. So TRIG seems to be well managed and is big and has been going for a long time. Okay, quickly onto Nvidia. So Nvidia is down from its peak, and I think that's a double top. Now, I saw this during the week. I thought this was really interesting. So this is monthly visits to ChatGPT. Yeah, we're meant to be in an AI boom. But actually,
extraordinary, isn't it? I
yeah,
never predicted this at all.
Yeah, people have stopped visiting.
That's going to be the big plus of the new iPhone, apparently, is a free subscription to ChatGPT.
Yeah.
But no one's using it.
Yeah, nobody's using it. So Nvidia's Q2 earnings, very good actually. And when you look at this, revenues have grown incredibly strongly, up 122% year on year, although revenue growth, sorry, is expected to slow to only 80% year on year. God, that's still amazing. And that's all due to big increases in capital expenditure at the other big tech firms. Net income was up 168% year on year. Amazing numbers. And yet the shares dropped because expectations were even higher. The shares are on a valuation of 59 times earnings and 32 times sales. Very, very highly valued. And I never touch these things because at some stage, as revenues slow, then the multiple starts to fall. And that is where we are now. So Nvidia's profit margins currently are marvelous, but that is a huge incentive for every other competitive firm to try and steal market share. And that's what I predict will happen in the coming years. I just don't think that is sustainable. And to me, and I've said this many times and been totally wrong, then in that it's just kept on going. But ultimately, I expect it to peak and you to get this double top formation you always get, which I think Nvidia is now showing. And then it takes much longer than you expect, but the end is inevitable, in my opinion, that the very high valuations just are unsustainable. And if we look back in 5 years' time, I fully expect Nvidia's share price to be a lot lower than it is now.
Keith, that chart is fantastic, isn't it? But that is the share price chart. If you look at the earnings that Cisco produced, they actually fulfilled the hopes. It's
Yes,
just that the share price was so far ahead of what could be delivered.
exactly. That's absolutely. Just people extrapolate growth to keep on going forever. And at some stage it stops. And then you go from being priced for perfection and infinite growth to being priced as a utility. And that's what happened to Cisco. I expect that to happen to Nvidia. So bottom line, I think the AI bubble increasingly looks like it's burst, and deflation is likely to take some time but be inexorable. And on to recession watch, Stuart.
Right, US travel statistics here. We've got the TSA checkpoint traveler throughput numbers. 2024 was comfortably ahead of 23 and 22 until recently. It seems to be weakening over the past few months. So is the US travel boom over? This is a scary chart. US office vacancy rate, my goodness, look at that, approaching 20% and still rising.
Yeah.
That's scary.
Yeah. As leases are expiring, the vacancy rate keeps on rising.
Private sector payroll growth as a percentage of overall payroll growth has fallen below 40%. Historically, that only ever happened during recessions. US yield curve, well, this has been the great mystery, hasn't it? The yield curve does have a very good record of forecasting the recessions, but as we highlighted, I think at the very top of the show, the fact that it's now uninverted could be the timing signal. It often is for when the actual recession begins.
Yeah, and so when you look at all the labor statistics, unemployment rate is rising, consumers' expectations, i.e. that's how easy it is to get a job versus how difficult it is to get a job, the spread between the two, that is also saying that is more difficult to find a job. And the thing is, there's a feedback loop. As people think the jobs market is slowing, so, companies become more inclined to actually lay people off because they think it's going to be easier to rehire them.
Non-farm business sector, real hourly compensation. Okay, so this is interesting that actually over the past couple of years, real compensation has basically been pretty flat.
Yeah, and actually down from pandemic highs.
Hmm. Discount retailers are struggling as poorer US consumers cut their spending, though we did see that at the volume level,
Yeah.
that these discount stores are doing pretty well. So their margins presumably under a hell of a lot of pressure.
Well, apparently it's Walmart. Walmart have cut prices on 7,000 items and are just stealing everyone's lunch.
Right.
So Dollar Tree last week came out with poor results. Previous week it was Dollar General. But you see, Walmart marching ahead, all its competitors getting crushed.
Very efficient machine.
Yeah.
Recessions need a catalyst. This cycle lacks one, but I think it's often you only see the catalyst in the rear view mirror. It could
Yeah.
be, of course, that a market crash could become the catalyst. So the US economy appears to be slowing. There's little imminent sign of recession, but I think that the labor force is, or the labor market is really what is beginning to be an emergent concern.
Okay, thank you, Stuart. On to other charts. So, good news, UK will permanently close its last remaining coal-fired power station at Ratcliffe-on-Soar in Nottinghamshire on the 30th of September. And it's extraordinary the progress the UK has made towards being cutting its carbon emissions. So in 2015, we were still generating 35% of our electricity from coal. Now it's going to be zero. Thought this was interesting. This is the number of job cuts being attributed to AI, according to Challenger, and it's small but rising,
Convenient excuse?
possibly.
Yeah.
But again, these are tiny numbers.
Yeah.
When you think about the impact of AI, I'm just not seeing huge impacts. Good news. Now, this could be really good news for the increasingly elderly presenters of this show. So, UK researchers at the Medical Research Council and Imperial have stopped the gene interleukin 11 from working, and they found that extended the lives of mice by over 20%. So they treated 75-week-old mice, which is the equivalent to humans with the age of 55. That's rather rather close. With an antibody that turned off interleukin 11, and those drugs had an increased lifespan of around 22.4% for males and 25% for females. And not only that, the treatment reduced deaths from cancer and fibrosis, chronic inflammation, and poor metabolism, all hallmarks of aging. Very few side effects. So, Stuart, that aging society, if scientists at Imperial get their way, that could get a lot worse.
We'll have to increase the pension age.
Well, yeah, exactly. See how well that will go down.
Yeah.
And on to equities, Stuart.
Right, so a pretty tough week. It was quite painful in the States, and that cascaded elsewhere. Some notable numbers: Russell 2000 down 5% on the week, and Topics down 5.7% as well. Bitcoin was fairly weak, also off 4%, and the only major rise was in the VIX index, up 20% on the week, and is now around the 20 level.
So when we said earlier that VIX spiked, last month, I said volatility presages more volatility, and it seemed like the markets were, totally ignoring us and going straight back up to highs. Well, we were right. That's a double top.
Well, you're more of a believer in charts than I am, Keith. I'm agnostic on this, but yeah, there was no huge bounce back. The overall world equity index was down about 3% on the week.
Well, in general, Stuart, I'm not a great believer in charts. I mean, because other people obviously make them work, but I don't. But I do think that when a strong trend has been established, that it takes some time for investors to realize the trend has stopped. And so double tops, I think what happens is when you get initial unwind, people think, oh, it's going to, the trend's still untacked, and they drive it back up. And then slowly it becomes clear, actually, the trend has finished. And you then get subsidence from there. And so you often get, when you look at, Cisco, the chart we showed earlier, you get this, initial top, bounce back, and then actually it can't sustain the rise, drifts off. And I think that's what we're seeing.
Well, I understand the logic. I just don't trust myself not to see patterns that don't particularly really exist.
Yes, good point.
The all share, well, the UK has been sort of flat, hasn't it, for a few months now. It didn't take part in too much of the exuberance and hasn't actually been taking a big kicking on the way down either. Euro Stocks has been a bit weaker, off 2.5% for the week.
Yeah, reminder, I've found it mystifying the whole year because the Eurozone economy is doing very poorly, So how come it's up?
It's tricky, isn't it? Because markets and economies are interrelated, but stock markets can have very different compositions. So it's big pharmaceutical companies, it's luxury goods companies, companies that sell on the global market. Obviously, in mid and small cap, it's much more local. S&P 500. Well, I'm hoping this is the beginning of a downtrend, and Keith is right that is a double top, but I'm not making that particular call myself. Nasdaq looking a bit more sickly, off 5% for the week, still up 12% for the year. Russell 2000 off 5% again for the week, up 4% for the year. VIX, yes, I mean, this is your point, isn't it, Keith, that volatility breeds volatility. That spike, which I believe on an intraday basis in early August was into the 60s, relapsed, but now we're much more around the 20 level.
Yeah, and I'm expecting volatility to remain elevated. The period earlier in the year, the low level of volatility was just absolutely extraordinary. This is much more normal levels. It's just returning to some sort of normality.
The current P ratio of the S&P 500 is 50% higher than its long-term average. And I believe this is calculated in a slightly different way, isn't it? This is price to the peak of the trailing 12-month operating earnings. So this isn't the usual CAPE using the Schiller methodology, slightly different, but showing a very similar picture.
Yeah.
And those are earnings which are based on forecasts which seemingly are very optimistic. Operating earnings forecasts suggest earnings, is that what, in a year's time of $276 compared to 220 at the moment? That strikes me as very optimistic.
Yeah, absolutely. So, the very high valuations are based on really optimistic earnings forecasts, and I just cannot see any way that this can be met. And so, if that is what's propping up the market, strong earnings expectations, then when the market realizes reality, then I expect prices to go down. But, frankly, I've been wrong all year.
Analysts are beginning to cut their Q3 earnings estimates as they're required to align themselves with the company's likely results. So reality is beginning to dawn. I mean, that is a pretty common pattern, except during the pandemic.
Yeah, and actually, the cuts aren't enormous. I mean, currently, Q3 earnings, the US economy is doing fine. So they don't really have to cut them. But at some stage, their earnings forecast in the coming year and a half are just absurd.
Well, they imply fabulous margins. I mean, we used to say that margins were a mean reverting series, but that hasn't really been the case in the past 5-6 years. That margins have continued to stay high and not been competed away. History indicates that equities tend to be weak in the period just before election day. So the blue line here suggesting sort of weak to down in the period between now and election day in November. But then they suggest a very a huge bounce
Yeah.
after the election. Oh, this was a chart I hadn't appreciated. Here is looking at defense stocks. Aerospace and defense has produced 12% a year since 1989, beating the S&P, which is at 10% a year, and beating industrials, which are at 8% a year. Now, this did surprise me because I thought last week we had a chart looking at capital intensive and non-capital intensive industries, and you would have thought aerospace and defense would be typical capital intensive industries, but on this basis, that they've actually done much better than the S&P. All right, Intel. We've covered Nvidia. Intel is the opposite story, or it's a it's a forecast of what's going to happen to Nvidia, because obviously Intel was once the darling of the semiconductor sector. It was innovating, it was keeping ahead, its moat was unsurpassable until it was surpassed.
Yeah.
And the stock is now pretty small, I think, about sort of 90 billion in market cap. It's pretty tiny.
Yeah, absolutely. You know, Nvidia's worth trillions, and you're right. I think Intel's worth, 90 billion or something.
Yeah, it's got a few government contracts to try to help out via the CHIPS Act, which I guess was directed. These grants were directed towards Intel when Intel was the chief, was the gorilla, was the darling semiconductor sector. But now it looks like a sort of state support mechanism for a dying company. In the past 5 years, Intel shares are down 63%, whereas Nvidia is up 2,200%. Extraordinary. Investors have gone all in on tech over the past year. I think we know this, don't we? Our fear, or at least my fear, is that this is performance chasing, and this would be seen as a contrary indicator. But the market share of tech ETFs seemingly has stretched up to 40%. Just phenomenal, scary, avoid in my case. Valuations have been pushed up, of course. The market PE for the technology, media, telecom sector is now at about 40, compared to the rest of the market at about 25.
Yeah, I don't know about you, Stuart, but I just get the feeling the mood has changed. Just in the volatility the last couple of months, and Nvidia beating earnings, but the shares falling anyway. That all seems to me that the market is topping. The bubble we've been talking about in AI is topping, and in the Mag 7. And investors have rushed in, have piled into ETFs in the Mag 7 and AI. And if it starts to fall, then a lot of that speculative money will flow out again. And that's what causes sharp drops in the stock market.
Well, that's certainly my sense that a lot of the storylines are now becoming about the big capex from the Mag 7 needing to be thrown at the AI hope, but that fundamentally changing the nature of those tech businesses, which previously have been so capital light, producing so much cash flow from their sales, and that fundamental story beginning to change, that there's a lot of capex that previously wasn't necessary.
Thanks, Stuart. On to commodities. Summary: oil, very weak. Industrial metals, mixed bag, but net weak, I would say, particularly iron. Precious metals, resilient, strong, up slightly on the week. Turning to energy, so Brent and WTI, very poor. So down to new lows for the year, down 6% on the week. And that is despite OPEC pushing back its proposed production increases. So this is Brent. That is an ugly looking chart. Very good for inflation, but the oil price is diagnosing a weakening world economy. This is WTI. Lows for the year. Numbers specific to the oil market, and all that is happening despite inventory draws in the US. So the US oil market is undersupplied, but still the oil price is falling. US crude production remains steady at 13,300,000 barrels a day. That's below the peak of the year. And so far, we are not seeing the surge in US oil production that the EIA had been predicting for the end of the year. Let's see what happens in the coming quarter. Baker Hughes rig count remains stable at 483, and that's down on the year. Some charts specific to the oil market. Well, hedge funds are giving up on oil. They have slashed their positioning to the lowest it's been since what, 2012? Ever? And that's despite global crude inventories being at an all-time low. And when I say all-time, that's back to 2017. These are EU natural gas futures, and natural gas prices are not falling in line with oil prices. And that's actually not great for European industry and not great for UK and European consumers. UK gas prices are very similar. Now, talking about coal, so the UK has closed its last coal-fired power station. The grey dots are closing or closed coal-fired power stations. The blue dots are coal-fired power stations under construction. Green are permitted, pre-permit or announced. And you'll see that although in the West we have closed all our coal-fired power stations, in the East there are 1,000, I repeat that, 1,000 either under construction or being permitted. So coal's going to be around for a long time. On to industrial metals, Stuart.
Right, well, picking out some headline numbers here. Iron ore down 7% on the week and 35% year to date. Conversely, picking a positive number for the year, tin is up to 20%. But I think it is that iron ore number, isn't it, that's reflective of this China's slowdown and possibly more broad economic slowdown across the world.
Yeah, and highlight copper as being resilient. Up 1.2% on the week, up 5% year to date. But generally, when you look at this chart, commodities are diagnosing a weak global economy.
Well, talking of which, aluminium, that's not a particularly attractive chart, is it? Having fallen from 2,500 to 2,355 in pretty much a straight line over the past few weeks. China's primary aluminium output has hit a fresh peak. So presumably it's not just about demand, it's about supply. And this sort of reinforces my idea that China is all about GDP, is not about profit, it's not about return on capital. So things are still being produced whether they're needed or not.
Yeah.
Copper, as Keith said, not showing the same weakness as iron ore, sort of being flattish for over the past month or so. Obviously, we all know the long-term story for copper, but I think Goldman Sachs their reduction in their copper price forecast was really based on the fact that the transition, yes, it'll play out over years, but it's not like you're going to buy the copper, for use in 5-7 years' time. It's actually a market that is difficult to store, so you're more influenced by the short-term demands. Now, that's the iron ore picture. Awful all year, really, from 140 down to 91 this year. Lithium, also ugly chart. Step changes down, going on and on.
Yeah, so last week we were saying maybe it's stabilized. Well, didn't last long.
Neodymium, good. Any story here, Keith? That's picked up quite a bit, hasn't it, over the past month?
Yeah, well, China have put in curbs on rare metal exports, and neodymium is used in electric motors and dynamos. So they're a big component for wind turbines. So the curbs seem to have led to rises in the price, but it seems to have peaked.
Nickel looking a bit more like the aluminium picture, down in a straight line over the past few weeks.
Yeah, but the nickel market over the course of the last year has shown, was mystifying. And we know there's this flood of nickel coming out of Indonesia in the next few years. And yet, between February and June, the price shot up. Fundamentals reasserted themselves slowly.
Tin, well, not too bad a picture. That had a good spring and has sort of been broadly stable since then, up to date, year to date, up 21%. So turning to precious metals, fairly quiet week, really. Gold and silver up 0.5%, and up, plus or minus 20% year to date. Platinum and rhodium, however, had a bit of a bounce, up 3 or 4% each. Gold, well, that's quite a nice, encouraging picture. I'm sure Richard will be basking in the profits from this. $2,500 an ounce. The punters are buying gold, apparently. Well, I certainly have been occasionally buying a little gold ETF, not on Richard's scale, but for me, it's insurance, and I want to keep a certain sort of percent of my portfolio in gold. But the big buyers of gold in the first half of the year were central banks. I think this is quite a structural story, isn't it? As China, Russia, possibly India want to disentangle themselves from the US-dominated payment system.
Yeah, but again, the value of gold depends on everyone valuing it. If they all decide that gold is where, a store of value and they buy it, then fine. But if, it doesn't have any intrinsic use, so it's sort of a cultural meme.
Well, it is, but it's one, with 1,000+ years of pedigree. And
True.
in a sense, what are you going to do if you do worry about monetary chaos, if you do worry about fiscal deficits, if you worry about persistent inflation, central banks imposing financial repression? Then if that's your diagnosis, well, where do you go? And you may not intellectually totally believe gold, but at the margin, that's where you're going to see demand from even people like me, buying a bit as a hedge.
No, I agree.
Silver, not as encouraging a picture as the gold chart to my eye, but still 17% up year to date. Platinum, difficult to describe this one, but sort of going nowhere over the past year, really, after a bit of a flurry in May time. Rhodium, well, I suppose that chart is sort of going up, but is there much demand for rhodium? Is it used so much?
Well, these are all catalytic metals, and actually they're bottomed because there is still demand for catalytic converters as the EV transition proves to be slower than anticipated.
Palladium, well, also for the past 6 months, been pretty flat, plus or minus around 1,000.
Okay, thank you, students. On to rates, and the yield curve shifted downwards last week, which is good news, and is down over the course of the last year. After non-farm payrolls and generally the labor market data in the US all came out soft, and stock markets appear to have peaked. In the US, this to me is a much healthier looking yield curve, where the yield curve is generally downward sloping, than is the UK, where you have this strange rise in between 10 and 40 years to a much greater extent than in the US.
Heath, just before we move on from that chart, I've been reading quite a bit of commentary about how the US is issuing a lot of short-term debt rather than long-term debt, which, from a the first level observation seems odd because the interest rate is higher, and surely if you're worried about your deficit, you would be trying to lock in for as long as you possibly can. But I've heard almost conspiracy theories that this is an effort to bolster the amount of collateral that or collateral possible assets for people to post to enable markets to continue to function. But possibly a quite technical topic that is open to misinterpretation.
Well, I frankly read that as the Treasury expecting that long-term rates will come down and wanting to issue short-term bills and then wait until long-term rates are down further before issuing long-term debt. But perhaps that's wishful thinking on my part. So this is interesting. This is markets outlook for interest rates, and you'll see that the current path is for it to reach a low of, was that 3.25% in 2026, and the market is now expecting rates to come down faster than it previously had. But you'll see, last year, as we know, markets were expecting rapid rate cuts and they just never came. So these charts are always wrong. And what's different this time is markets are already pricing in a lot of cuts. This is unprecedented. Normally, at the start of an easing cycle, markets aren't pricing in many cuts at all. So are markets over-optimistic this time? Generally, the Fed cuts more than markets expect. The danger is excessive expectations mean that the Fed doesn't meet those expectations. And I thought this is odd. So real money, increasingly long duration. Speculators, short duration. The smart money, short duration. Bad for me. Now, the FT had a piece this week on why the Bank of England may cut rates faster than expected. And I, obviously, with a very long position in gilts, really want this to be true, but I also think it is true. Fiscal policy is set to tighten. That is a big one for me. So the Labour government, we have a budget in October, and they're going to cut spending and increase taxes. That is not good for the UK economy. Interest rates are currently high, and we've talked about this many times, but the lags inherent in monetary policy mean that it is continuing to have an effect as mortgages are refinanced on the higher rates, and that will continue for the next couple of years as 2 to 5 year mortgages, which were fixed during the pandemic at low interest rates, are refinanced. So higher interest rates continue to be a drag on the economy going forwards. And if the government tightens policy, reduces the deficit, then in order for GDP merely to be maintained, then private sector spending has to increase. And how's that going to happen unless interest rates come down? And I also think that the surprising strength of the UK economy over the past year has been in part due to the extraordinary rise in the number of people in this country last year, thanks to 700,000 net immigration. Now, that is a one-off boost that will fade, and immigration is going to drop sharply in 2024 thanks to changes in visa policy. But the UK 2-year has actually risen quite sharply over the last month. Odd. The 10-year down. So Bank of England regaining a bit of credibility in its inflation fight, I think. The 30-year is certainly peaked, but is not coming down anywhere near as sharply as I'd like, unlike the US, where inflation is under control. The economy seems to be slowing, or the jobs market appears to be slowing, and the market is expecting interest rate cuts that they're not in the UK as yet. German 10-year Bund, well down from its peak in a way the UK is not. Okay, concluding comments. So US non-farm payrolls and JOLTs all came in soft. The US labour market is slowing and is continuing to slow. UK labour market, if we step back, the general trend is of slowing job creation. Equity markets appear to have peaked for now. We are in September, which is traditionally a weak and volatile month for equity markets. Everywhere, inflation is falling. The question is now whether central banks can engineer a soft landing by cutting interest rates. But what this cycle has taught us is that the lags involved in monetary policy are very long. And frankly, you can look at US inflation and wonder whether interest rates have had any effect at all in bringing it down, or is it just the aftermath of a supply shock. So if interest rates didn't work to slow the economy, will they work to stimulate it? Watch this space. Stuart, how have you been? Have you done anything?
No, not since I was on last week when I mentioned that I'd bought a venture capital trust. Apart from that, I'm sitting on my hands. And you, Keith?
I'm having a terrible year, as you know, and this podcast is set up to examine the macroeconomy with the aim of then making asset allocations dependent on my view of the macroeconomy. And the economy has just been far more resilient than I expected. Is that changing? So I had a better week, up 2.5%, but still having a terrible year. Now, I actually, having taken some of my position in long-dated gilts off before my holiday to Japan. Last week I put it back on, and I bought TG51. Now that is lower duration than the TG58 I had before I went to Japan, and TG51 is slightly less interest sensitive to interest rate, but it has the highest real yield according to Yield GIMP. So I'm frankly expecting Labour government to start to cut the deficit, raise taxes. All of that will be bad for the UK economy and should mean that inflation comes under control as the economy slows, allowing the Bank of England to cut rates. And as we've discussed many times, I think real interest rates are a function of productivity, and the UK's productivity is bloody awful. So I expect that interest rates medium term to head back to where they were pre-pandemic, and I also expect capital gains tax to rise, etc. So I am looking to lock in some yield going forwards and outside of my SIP to buy some trig and hold it for the long term. But I put in a order in trig not been filled yet. So this is TG51. It's bottomed, but I don't think you can say the trend is upwards. But if you buy this, you're getting inflation plus 1.3% per annum till 2051, and that is almost entirely tax-free. And frankly, 4.5%, actually 4 and a bit percent, I forget the exact number, tax-free when capital gains tax and income taxes are rising. Actually, that is hard to beat. And I think that core part of the portfolio these days, you should have something that is going to provide solid real returns in a way that pre-pandemic you could not get real returns tax-free. The yield on index-linked gilts was firmly negative.
I totally agree with that, Keith. And you mentioned Yield GIMP before, but just to give a shout out, that's a fabulous website. Very clear, very simple, very accurate. It's a great place to look if you're looking to buy either regular or index-linked gilts, and particularly in this environment where engineering a gilt portfolio to produce capital gains which are not taxed is a fantastically efficient way of building part of your portfolio.
Yeah. And bear in mind that, 4% compounded over 10 years, you're talking about 50% rise in the nominal value of your portfolio, which outside of a tax wrapper of if your shares rose by 50%, you would have to pay capital gains tax on that. If gilts rise by 50%, you don't. And that is a big potential saving and saves your wealth from erosion due to inflation, which is a form of tax in itself. Now, reminder, TG51 and all these long-dated index and gilts in 2021, their price was much, much higher than it is now. And I'm expecting, as interest rate expectations normalize, them to head back up. Now, they're never going to reach 220, but I still expect TG51 to head to 100, 120 medium term. So that rise would all be tax-free, and it's a question of patience, and I have the time to wait. Still got 30 years of this game. One bad year is not going to cause me to panic. And I have also this week sold my US dollar bonds. I'm repatriating the assets, and I'm going to buy trig, and I'm going to buy some yield. I think that the US dollar could be structurally weak from here, and actually I prefer UK gilts, which are tax-free, to US treasuries, and actually I'm going to try to buy some sterling yield. Okay, that's it. Thank you all for watching. I don't think we came in on target, sadly, but we will do our best to be shorter in future. Thank you to Stuart Owen. Please can you press like and subscribe to the channel, and it's goodbye from me, Keith Jordan.
And it's goodbye from me, Stuart Owen.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website, or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for